Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session of Financial Management Revision Series for CA Intermediate November 2023 attempt. First of all, like the video, share with all your friends, and this is going to be another important chapter in the series, that is cost of capital. Very interesting, very easy. And let's quickly get going with the cost of capital, that what all is there in the cost of capital. Right, I know many of the students have been waiting for these lectures because some of the students are preparing from these lectures itself. Okay, so first of all, let's try to understand what is capital, sir. What is capital? This word capital, if we talk about this word capital, sir, what is this capital? So this capital means the money that is used for running the business, right? Capital means the money that is being used for running the business, right? One second. Okay, now capital means money used for running business. Right, sir? This is what is capital. Now, this money can be in the form of debt or it can be in the form of equity. What is debt? Debt is outsiders' money. Now, debt is what? Debt is outsiders' money. Right? And equity is what? Equity is own funds. Equity is own funds. Now this is how you can utilize this. You can raise money for running a business, right? But every source of capital, every source of money from where you are raising the money involves some sort of a cost. If you are using the outsiders money, the outsiders are not going to give the money free of cost. They will charge interest from you. If you are going to the bank for taking a bank loan, is the bank going to give you the loan without any interest, sir? Is the bank going to give you the loan without any charges? The bank says, you are going to use my money. How can I give it to you free of cost? Isn't it? So bank will charge what? The bank will charge interest on debt. That is why we say every source of capital involves some sort of cost in it. That is why this chapter is there. That is cost of capital. Now, if we talk about debt, what is the cost involved in it? Sir, the cost is the interest cost, net of tax. Why I'm writing this net of tax? Because not tax, interest is a tax deductible expense. Write it here, interest. Interest paid on the debt, it is a tax deductible expenditure. You can claim the tax savings on this. That is why we say, what is the cost? If you have to pay 100 rupees as the interest, but you can save 10% as tax, what is the net cost? Net cost is only and only 90 rupees. Right? That is why I'm saying interest is the cost of the debt. That means for using the money, what is the cost that you will have to pay? That is the, for debt, it is the interest cost. For equity share capital, we have to pay the equity dividends from the residual earnings. Remember the income statement that we have already studied about how we calculate the residual earnings of the income available for equity shareholders, and to the equity shareholders we will have to pay the dividend. That is a cost to the company. The main aspect here is that company is a separate entity, and the person who have invested in the company, those are the separate entities, or running the business, those are the separate entities. Now coming to preference share capital, what is the cost of preference share capital? That is preference dividend. But important point here to know is that preference dividend is not a tax deductible expense. You cannot claim the tax benefit on the preference dividend because preference dividend is paid from the earnings after paying off the taxes, right? In case of retained earnings, there is a opportunity cost. There was opportunity that those retained earnings could have been distributed, right? So there is an opportunity cost that is related to retained earnings. And to whom these retained earnings belong, sir? These retained earnings belong to the shareholders only. To whom? To equity. These retained earnings belong to equity shareholders only, sir. Right? So this again belongs to equity shareholders. How to calculate the cost? Now this is the basic, that every cost, every source of the capital will involve some sort of a cost that is to be paid, right? It is not that you will get the capital absolutely free of cost. right? Now this is the cost from the viewpoint of a company. So imagine there is a company that is taking the debt from someone or taking a debt from you, right? And you will say, company, pay me interest. Or you are the equity shareholder, you have given the money to that company, you will ask company, pay me dividend, right? So this is what is going to happen, that from the company point of view, if we look at it from the business point of view, there is always some sort of a cost that is involved, right? Right, sir. Now moving on to the individual costs. Now we'll move on to the individual cost, that is the cost of debt. So cost of debt, we have divided it into three parts. One is the irredeemable debt. What is irredeemable debt? Where only the interest is to be paid, the principal amount is not to be repaid, right? That is known as irredeemable debt. And second is redeemable debt. What is redeemable debt? That interest is to be paid from time to time. That is, every year you have to pay some interest. Whatever the interest rate is fixed, you have to pay interest every year. But at the same time, the principal amount is to be repaid at the end of a specified period, right? Let's say if you are taking a loan from the bank for 3 years. So this is 1 year, 2 year and 3 year, right? 0, 1, 2, 3. Here you are taking the loan 1 year. Here what you will pay at the end of the first year, you will pay interest here, sir. Here also you will pay interest, sir, right? And at the end of the third year, you will be paying interest also, plus you will be paying the principal amount also, right? Two things you will be paying. One is the interest, another thing is the principal amount, right? That is known as redemption value. This is what we call it as redemption value. We call it as redemption value, right? RV. So third part is the convertible debt. The convertible debt means at the end of a specified period, this is a part of redeemable debt only. This is a part of redeemable debt only, that at the end of a specified period, you have the option whether you want to take the cash or you want to convert your debt into equity shares, right? That is one option, that is known as convertible debt. Now how to calculate each of the things, let's try to focus on that. How to calculate the redeemable debt? For the redeemable debt, what is your cost of debt? Cost of debt is denoted by KD. And how you are going to calculate KD? That is interest into 1 minus tax, because interest is a tax deductible expenditure, divided by NP. NP is what? NP is the net proceeds. What is NP here? If you talk about NP, NP is net proceeds, right? Now, certain important points related to the net proceeds, listen to it very carefully, right? Firstly, if net proceeds are given in the question as well as the market price is given in the question, right? What you have to take is the market price, right? So there are certain points that I'll write down. If net proceeds and market price both are given, you have to give priority to market price, right? How the net proceed is calculated? How the net proceed is calculated? Let's say the face value of debt, face value of the debenture is rupees 100, right? And you are issuing this debenture at a discount, right? There is a discount of, let's say, 5%. Clear? Now, what will be the issue price here? At what price? What will be the issue price? The issue price will be 100 minus 5% of 100, right? That is 95 rupees. Now, you are going to issue the debenture at 95 rupees. Whenever you are issuing, there might be a flotation cost, right? Here he says flotation cost is equal to 2%. Now there is a 2% flotation cost. Now this flotation cost is to be calculated on what? Whether it is to be calculated on 100 rupees or whether it is to be calculated on 95 rupees. Sir, flotation cost will be calculated on the issue price, right? So this 2% will be calculated on this. If I talk about from here the net proceeds will be issue price issue price minus flotation cost. Issue price minus flotation cost. Issue price is 95 minus 2% flotation cost on 95 rupees. How much this will be, sir? 95 minus 2%, that will come to 93.1. This will be the net proceeds that we are going to take it here, sir, for the purpose of KD. Very important. Clear? So priority, if net proceeds and market price both are available, give priority to the market price, and this is how the net proceeds are to be calculated. In the question, instead of discount, there can be premium also. There can be premium also. In case of premium, this issue price will be 100 plus 5%, 105 rupees. Flotation cost will be calculated on the issue price. Right? This is 93.1. So this is regarding the net proceeds, and interest, because it is a tax deductible expenditure, you have to take this 1 minus tax rate. This is in case of irredeemable debt, where there is no redemption of the debt. Right? Now coming to the redeemable debt, how to calculate the value of KD under the redeemable debt, sir? Here the KD will be calculated as, here the KD will be calculated as I into 1 minus tax. Sir, interest will be there, but at the same time you will have to pay the redemption value, right? Redemption value minus net proceeds divided by N, where N is the number of years, right? Whole divided by redemption value plus net proceeds divided by 2. N is what? N is the number of years, right? So RV is what? RV is the redemption value. That here, if you are issuing the debenture of the face value rupees 100, you are issuing it, let's say, at a discount. What is the issue price? You are issuing it at a discount of 10 rupees. That means you are issuing at 90 rupees. But here, at the time of redemption, you are redeeming the debenture at 100 rupees. So redemption value can be more than the net proceeds. It can be equal to net proceeds, or it can be less than the net proceeds also, right? But redemption value will be there. The number of years will be given in the question, right? So this is how the KD, that is the cost of debt, is calculated if there is a redeemable debt, right? Now here a few points if you want to note, that RV, that is redemption value, can be more than net proceeds. It can be, redemption value can be less than net proceeds, right? Or redemption value can be equal to net proceeds, right? If nothing is mentioned, if question is silent, this is regarding the net proceeds, right? If question is silent, then redemption value equal to face value. Then you can take the redemption value as being equal to the face value of the debenture. This is what you have to take, sir. Clear? Redemption value is to be taken equal to the face value of the debenture. So this is regarding the redeemable debt. Now coming to the convertible debt. In case of convertible debt, let's say you have issued the debt at the rate of 100 rupees. Now at the end of a specified period, you have the option whether to take the cash, right? The company says we can pay you cash, but the cash that we'll be paying is 100 rupees. Or instead of one debenture, you take the share from us. The value of the share is 120 rupees. Right? Either take cash or take the shares. What will you go for that? Sir, obviously you will go for the shares. Now this, if you go for the shares, if the shares is having the more value than the cash that is being offered, right, then you will go for the shares, and this 120 becomes your what? This 120 becomes your redemption value, right? Rest everything will be, the formula will remain the same. The cost of debt, calculation of cost of debt will remain same. The only thing is this cash versus the shares is being done to calculate what will be the redemption value of that debt, right? That is why I told you that this convertible debt is a part of the redeemable debt itself. It is a part of redeemable debt itself. So this is all about the cost of debt. I hope this much is clear to you, right? This all is about the cost of debt, that is divided into three parts. No, one more thing, sir, one more thing. If he asks you to calculate the cost of debt using the IRR or the yield to maturity, right? This can be there, sir. This can be there. I'll take it here. So they can ask you to calculate the KD using IRR or the yield to maturity. Now, you have already studied about the IRR, sir. We have already studied in the chapter of capital budgeting and investment decisions. Now, what is the scenario here? What is going to be the scenario here? Listen to it very carefully. At zero period, you are issuing the debentures, right? You will do what, sir? You will issue debentures, let's say at the rate of rupees 100, right? This is what? This is now your cash inflow. When you will issue the debentures, you will have a cash inflow of 100 rupees. Now, at the end of the first year, you will pay what? You will pay interest. Let's say 10 rupees is the interest. This is what? This is your cash outflow. Right? Again, at the second year, you will pay interest. Let's say it is 10 rupees. Again, what? Again, it is your cash outflow. Let's say it is a 3-year debenture, not a project, sir. Now, at the end of 3 years, you will pay interest at the rate of 10 rupees, plus you will pay the principal amount also at the rate of maybe 100 rupees, right? If the redemption value, this is what is redemption value, sir. This is again your cash outflow, right? Now, if you have at respective periods, if you have the cash inflows and the cash outflows, can you calculate IRR from this? Yes, sir. You can calculate IRR from this easily. The IRR, you can calculate the NPV at the rate of a certain percentage, let's say 10%, right? If it is giving you the positive NPV, then you go for the NPV, let's say at 20%. If it gives you the negative NPV, then go for interpolation and calculate the IRR. That will be your cost of debt, right? Through interpolation, you can calculate IRR, and this IRR will be what? This IRR will be your cost of debt, right? So in the question, if specifically it is mentioned that you have to calculate the cost of debt using the yield to maturity, YTM is what? YTM is yield to maturity. Then you have to follow the IRR method, yield to maturity, right? Then you have to use the IRR method. This is how it is to be utilized, right? And yes, there have been questions in the past on the yield to maturity. So now this is all about cost of debt. We have discussed everything about the cost of debt. I hope this is clear, right? Now moving on to the next segment, that is cost of preference shares, which is absolutely similar to cost of debt with a small change. What is the cost of preference shares? The cost related to preference share is the again, it can be divided into two parts. One is the irredeemable preference shares and another one is the redeemable preference shares. What are irredeemable? In the irredeemable preference shares, only the dividend is to be paid. The principal amount of preference share is not to be repaid, right? The main amount of preference shares, principal amount of the main amount of preference shares. Here, the dividend is to be paid from time to time and the principal amount is to be repaid at the end of the specified period. Same as we have done in the case of debt, sir. Absolutely same as we have done in the case of debt. Calculation will also be same. The only difference here being that preference dividend is not a tax deductible expenditure, right? So how to calculate? This is denoted by KP. KP is calculated as preference dividend divided by net proceeds. The rules of the net proceed will remain absolutely same. If there is a flotation cost or if you are issuing the preference shares at a discount or at a premium, that will become the issue price. Then there can be flotation cost. Flotation cost is to be calculated on what? Flotation cost is to be calculated on the issue price. The rules remain absolutely same as we have discussed in case of debt, sir, right? Okay, so after that there will be redeemable preference shares. Redeemable preference shares, again the concept remains absolutely same, sir. KP is equal to preference dividend. Only thing is tax is not to be considered, plus preference dividend plus redemption value minus net proceeds divided by n whole divided by redemption value plus net proceeds divided by 2, right? So this is going to be the, in case of redeemable preference shares, this is all about the preference shares, sir. That's it. No convertible preference shares, nothing, only irredeemable preference shares or the redeemable preference shares. And the specific thing is Preference dividend is not a tax deductible expenditure. Preference dividend is not a tax deductible expenditure. Is not a tax deductible expenditure, right? So this is very, very important. You have to remember, right? Again, the redemption value rules will remain the same. Redemption value can be more than the net proceeds. Redemption value can be equal to the net proceeds. Redemption value can be less than the net proceeds. And if nothing is mentioned, then redemption value will be equal to the face value of the preference shares, right? These are the few small important points that you should remember, because these small important points can cause the confusion in during the examination, right? So you have to remember this. You can write down all this. You can write down all this, sir. Everything is going to help you for the quick revision during the examination process. Okay, now coming to the next segment, that is the cost of equity shares. Now, equity shares are what? Equity shares are our own earnings, sir. Right? Apna paisa, sir. Equity share is our own funds, right? Now, there are certain things that you must, remember before we start with the equity shares, right? There are certain terminologies that you have to remember before we start with the equity shares. What are that? One is the what can be that, sir? The one is the growth rate retention ratio. I'll talk about retention ratio. What is retention ratio? Retention ratio tells us that out of the earnings per share, let's say your EPS is 100 rupees. Now, out of this 100 rupees, you have decided to distribute 60 as dividend, and you have decided to retain 40 rupees in the business. So retention ratio tells us that out of this 100 rupees, how much of the amount you are going to retain in the business, right? That will be 40. That is retention divided by 100, that is 40%. Or how we can calculate it? Or it can be 1 minus dividend payout ratio. What is dividend payout ratio? Dividend payout ratio is that out of this 100 rupees, how much is the dividend that you are going to pay, right? This retention ratio is denoted by small b. Okay, I'll write it with a separate color so that you can easily. This is denoted by small b, retention ratio, right? This is denoted by small b. Now, another thing that is important here is r, small r, or wait, I'll write it as rate of return on retained earnings. Rate of return on retained earnings, and it is denoted by what? It is denoted by small r. Sir, why are you retaining the money in the business? You want to retain the money out of the earnings. You want to retain some money and you want to invest that money, right? And what is the return that you are going to get from that retained earnings? That is given by r, right? Now what happens, sir? Now what will happen? The next point is, the next relationship here is the growth rate. What is growth rate? It is denoted by G. It is denoted by small g, sir. What is this growth rate? Growth rate says you have retained the money. Why have you retained the money? Because you want to reinvest it somewhere, and that will lead to what? That will lead to the growth of the business, right? So how the growth is being defined, that whatever the money, if you have retained 40 rupees, on that 40 rupees, what is the growth, or what is the this return that you have earned? That is denoted by B into R. Retention ratio multiplied by R, that is the rate of return on the retained earnings, that is that denotes the growth rate, that is G, right? So these are the few important things that you have to remember here, sir. Clear? Now we can move on to the various methods of the cost of equity shares. Please remember these things, very important, because sometimes in the question the information can be given in the indirect way. So if you have studied everything about it, you will be able to interpret the right information and put it in the right way, right? That is really important. Now coming to the methods here, sir. Okay, another thing, sir. Wait. Before moving, we'll talk about P naught. P naught is what? The current market price of share. I'll give you the certain terminologies beforehand, right? Current market price of share, right? Then there will be terminology that is D1. D1 is the dividend. D1 is what? Not the dividend. I'll say the expected dividend. D1 is the expected dividend at the end of period. At the end of a period. Now, what will be the expected dividend? That is how to calculate D1. Sir, you have currently paid a dividend, that is D0. D0 is you just have paid a dividend. You have just paid the dividend, and over a period of next 1 year, there will be growth also. There will be growth also. So D0 into 1 plus growth rate. This is how the D1 will be calculated. Now, whether this, sometimes this information will be given in the question, you have to interpret it very carefully. The question says the expected dividend to be paid, then he is talking about D1. If the question says the company has just paid a dividend of 10 rupees, that means the company is talking about D0, then D1 is to be calculated, right? So the language of the question, the interpretation of the language of the question becomes really important. Whether the question says that the expected dividend to be paid by the company, that means he's talking about D1. But if the language says the company has just paid a dividend, that means it's talking about D0, right? Then there will be term that is E1. E1 is the expected earnings at the end of a particular year. This is expected earnings at the end of a period, or a year, or a period, whatever you may write it, right? So these are the various terminologies which are used in the cost, calculating the cost of equity shares. Now, the first model here that we are getting is the dividend price approach. The dividend price approach, how to calculate the KE under KE. Now it is denoted by KE, cost of equity, that is D1 divided by P naught, right? As per the current price of the market share, what is the dividend that you are expecting to pay at the end of the period? That is denoted by the cost of equity. What is the cost of equity? That's the dividend, whatever the dividend you are going to pay, right? And what is the market price of the share? That multiplied by 100 is obvious, sir, to calculate in percentage. Now the dividend price plus the growth rate. Now here the KE will be calculated as D0 into 1 plus G. 1 plus G, it is D1 only, right? Divided by P naught plus overall growth rate that you are targeting to achieve, right? The overall growth rate that you are targeting to achieve. Then next model, earnings price approach. He says the cost can be calculated on the basis of earnings also, because ultimately the dividends are to be paid from earnings only, right? So here it is E1 divided by P naught, right? Then earnings price plus growth, that is KE is equal to E1 divided by P naught plus growth rate, right? Then last one is capital asset pricing model. Now this is something different. Capital asset pricing model. Capital asset pricing model, the KE is calculated as RF plus beta value into RM minus RF. Right? Now, what is RF? The RF is that the company can always invest in the risk-free investment. That is, the government bonds can be there, right? So RF denotes the risk-free rate of interest. This denotes the risk-free rate of interest, right? Now, what is this? This is the beta value. This will be given in the question. Don't go into the calculation. This is the beta value. This is what is? This is the market rate of return. This is the risk-free rate of interest, not interest, return. Risk-free rate of return, sir. Right? This is the market rate of return. Right? That in the market you might get something extra, but at the same time you will have to take the risk. Minus RF is the risk-free rate of interest. Now this total is known as risk premium. That what if you want to, if you are going to take the risk, what is that extra benefit that you will get by taking the risk? What is that extra return that you will get by taking the risk if you invest in the market instead of the risk free rate of interest or instead of the risk free securities, right? So this is how the capital asset pricing model will be given. Everything will be given to you, so nothing to worry about it. Risk free rate given to you, beta value given to you. One thing that you have to be very careful about is sometime the question might give you the risk premium is 10%. That means if the question says it is risk premium, that means this value is given. RM minus RF is given to you. Then in that case, this market rate of return is not given. Risk premium means this whole value, already subtracted value is given to you. You don't have to do it 10 minus risk-free rate is 5. No, this complete 10 is given to you, right? And if it says the market rate of return, then RM is given to you, right? So you have to be little bit careful with this thing. What is given in the question, that is why I always say reading the question carefully is the most important thing. Now, another thing related to this. Another important thing is that this is what? This is your market price of the share, or here the net proceeds might also be given, right? You have to give importance to market price of the share. Secondly, if there is a flotation cost, you have to subtract the flotation cost from here, minus flotation cost, right? So you have to be careful with this thing. If the market price is there, flotation cost is given, then you have to subtract the flotation cost. So this is all about the cost of equity shares. We are done with the cost of preference, cost of debt, cost of equity. The next is cost of retained earnings. What is cost of retained earnings, sir? Retained earnings belong to whom? Retained earnings belong to the equity shareholders. So all the approaches similar to KE will be used for the calculation of retained earnings, sir. The only thing is, because the retained earnings are not traded in the market, they will not have the net proceeds. They will always have the market price. In case of the calculation of retained earnings, all these methods will be utilized. But here you have to always take the market price and not the net proceeds. Like I told you, here you can take the net proceeds if given in the question. But in case of retained earnings, you do not have to take the net proceeds. You have to take the market price only, because net proceeds is if you are going to issue it, right? Retained earnings are never issued, sir. Secondly, he says the retained earnings can be calculated in a different way if the dividends taxable in the hands of shareholders. What they are saying is, let's say you distribute the dividends. You distribute the dividend to the equity shareholders. The equity shareholders after that invest somewhere, or they can invest it, no issues in that. How can we calculate the KRE in that case? The KRE is KE. What is the cost of equity to the company? That means what is the company that will be paying to the equity shareholders? That is the dividend that is being distributed to the equity shareholders. That is what is that. That is KE, sir. On that KE, the equity shareholder will be paying the TP. TP is what? TP is the personal tax. TP is the personal tax that the equity shareholder will be paying. Now, whatever the money is left with the equity shareholder, that money the equity shareholder wants to invest. When he will invest, he might have to pay the brokerage on that. 1 minus B. B is what? B is the brokerage paid on investment. This is brokerage paid on investment, sir. Right? So this is how the KRE can be calculated in another way if it is taxable in the hands of shareholders, right? Mostly these approaches will be used. The most used will be these approaches only, right? So this is all about the cost of retained earnings. Now we have calculated the cost of debt. We have calculated the cost of preference shares. We have calculated the cost of shares also. The last thing is the overall cost of capital. What is overall? Now the company wants to know we have calculated the individual cost. The company says, tell me what will be the overall cost of capital. Sir, we can do simply, if 10% is the KD, 12% is the KP, 12% is KE, we can simply say 34%. No, sir. No. What you have to do is overall cost of capital, or what we call it as WACC. What is WACC, sir? He says you have to calculate the weighted average cost of capital, right? According to what is the amount of the debt funds invested, what is the amount of preference share capital invested, what is the amount of equity share capital invested. You have to calculate the cost of capital, right? So this is also known as weighted average cost of capital. Weighted average cost of capital, right? Weighted average cost of capital, sir. Now, this can be calculated in two ways. One is based on the book value. Another one is based on the market value. How the format is prepared, sir. Listen to it very carefully. How the format is prepared for this. I'll prepare the format here, right? Because some things I'll write there. Or I can prepare it. Wait. I'll prepare the format here itself. How to prepare the format? First, we'll write what are the various sources of finance. What are the various sources? One second, guys. What are the various sources of finance? Sources of finance means how much is the equity share capital, how much amount you have invested from the retained earnings, right? How much you have invested from, right, retained earnings. Then what can be another thing? Another thing is how much amount you have invested in the preference share capital, right? How much you have from the debt. Clear? So you will take the amount. You will take the amount. What is amount, sir? A1, A2, A3 and A4. What is the individual? This is TA. Right? This is the total amount that is invested in the business. A1 represents the amount of equity share capital. A2 represents the retained earnings. A3 is preference share capital and A4 is debt. Now, everything might be given in the balance sheet itself. I'm talking about the book value here. Book value means the values which are there in the balance sheet of the company. Those are known as the book values. All the values contained in the books of the company, those are known as the book values. Now, these are the book values. Now I'll calculate weight here. That out of the total investment, what is the weightage of the equity share capital? That is A1 divided by TA. What is the weightage of retained earnings? Right? What is the weightage of TA? A4 divided by TA. Right? This is how the weightage will be calculated. Now, after that, you have calculated the cost of capital. Cost of capital is KE you have calculated, KRE you have calculated, KP you have calculated, and KD you have calculated. Now, what will be your WACC? How will you calculate the WACC? Weight multiplied by this multiplied by KE will be equal to WACC. Right? Let's say it is W1. This multiplied by this will be W2. This multiplied by this will be W3. And this multiplied by this will be W4. This total TW, this is what is known as overall cost of capital. This is what is known as overall cost of capital, right? So in this case, the first thing will be to calculate the individual cost of capital, then to identify what is the amount of equity share capital, retained earnings, preference share capital, debt, and calculate the weights. Then the WACC will be calculated. This is the format that in which we can calculate the WACC. Now, regarding the book value, this I told you that if you have the book value, sir, will there be any difference? Book value means the values given in the balance sheet of company. Values given in the balance sheet of the company. Right? Right. Now, what are the market values? The market value is, let's say in your books, the equity share is worth 100 rupees, but in the market, the value of your equity share might be 130 rupees. Now he says, we want to calculate according to the market value weights. Sir, is there going to be any change in the format? No, sir. The format will remain same. The only thing is, here where you are taking the amount, here we were taking the book values, you will take the market value A1. Right, you will take the market value A2, you will take the market value A3, you will take the market value A4, right? You will take the market values instead of the book values. The market value rate will be given in the question, that equity share, let's say you have 1 lakh equity shares in the books. In the books it says the share value is 100 rupees, but in the market it is 125 rupees. So here what you will take, 1 lakh multiplied by 125 rupees. That will become your market value of the equity share. Then here you will take TMA, right? Total market value amount. You will calculate the weights, COC and WAC. Right, sir. But what is the problem in case of market value? The major problem in case of market value is related to the retained earnings. What is the problem here, sir? The major problem here is that, sir, one second. The major problem related to the retained earnings is that, sir, retained earnings do not have a market value. What I'm saying, sir, retained earnings do not have a market value. Then how to treat it, sir? If retained earnings do not have a market value, sir, how will you be able to find out this amount? MA2, how will you be able to find out? Sir, we will not be able to find out. Now, he says retained earnings belong to whom? The retained earnings belong to the equity shareholders, right? So he says the value of retained earnings is included in the market value of the equity shares. What is going to be the treatment? Two things. Listen to it carefully. Now, I'll say if KE and KRE are equal, right? If cost of equity and cost of retained earnings is equal, then what is there, sir? Do not show retained earnings separately. Do not show retained earnings separately, right? The value of retained earnings is included in the market price of equity share, right? Value of retained earning is included in market price of equity share. So you don't have to show the retained earnings separately. This will not be shown here, right? But if KE and KRE, if KE is not equal to KRE, then what will happen, sir? In that case, you will have to separate this KE and KRE. How will you separate it, sir? How will you separate it? In that case, the book value, the market value, not the book value. In this case, market value of equity shares, will be distributed between equity share capital and retained earnings. In which ratio? Right? Let's say the market value is 10,000 shares into 125. That is the market value of the equity shares. It is to be distributed between how much of the amount will be taken here and how much is to be taken here. It is to be distributed between equity share capital and retained earnings in the ratio of book values, right? It is to be distributed in the ratio of equity share capital and retained earnings in the ratio of book values. The book values will be available with you, sir. So this is how the overall cost of capital is to be calculated. More or less the format remains same. How to deal with the book value, how to deal with the market value. One more thing regarding the market value weights. Now, one more thing that is there is regarding the term loans. One more thing regarding the term loan. What is a term loan, sir? Term loan is the loan that you are taking it from the financial institution for a specified period, right? It is a sort of debt. But the problem is it is not traded in the market. It is not traded in market. Right? If you take a loan from the bank, whether that loan is being traded in the market, no sir. If it is a debenture is being traded in the market, you will get to know the market price. Now, if term loan is given in the question, it is not traded in the market, this term loan, how will you calculate the market value of the term loan now? Another situation in the market value waits, right? This is a cost of capital. Term loan is a capital that you are going to use and it will have a cost, sir. It will have a cost. You will have to pay interest on the term loan, but it is not being traded in the market. Then how to calculate market value at the time of market value waits? The market value will be equal to book value of term loan. Simple. Right? Market value will be equal to the book value of the term loan. This is another area that you have to be very careful about. Any doubts in this thing? So this is all about the cost of capital. One small topic, last one small topic, very small topic is, one very small topic is, that is marginal cost of capital. One last small topic is marginal cost of capital. Right? What is this marginal cost of capital, sir? Sir, the marginal cost of capital says you already have some capital, you want to raise additional capital. This is the cost of raising additional capital. Let's say you want to go for the expansion, additional capital. Let's say you are planning some expansion plans, and for that expansion you need rupees 50 lakhs. Right? Now there will be cost to this 50 lakhs, right? You need to find out what is the cost for raising this additional capital, that is known as marginal cost of capital. Rest everything remains same. Sir, it can be debt, it can be equity, it can be equity share capital, it can be retained earnings, it can be preference share capital. Everything remains same. All the rules remain same. Right? The only thing is we are calculating for, if you want to raise additional funds, what will be the cost that you will have to incur for these additional funds. Right? So this is all about the cost of capital that I wanted to discuss with you. All the concepts of the cost of capital we have covered in detail. Now you can try the ICAI module questions. There are certain questions which are tricky in the module. Please do all the questions very, very carefully. You will enjoy all the questions of the module. So stay tuned for the next chapters on financial management. Please let me know in the comment section, how are you feeling these lectures? How are you finding these lectures? Really helpful for the examinations, because we are focusing on the small points which are very important and which are the areas where you people can commit mistakes, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.